Hello traders, Andrew Curry here, and I want to look at whether or not you should be trading higher or lower time frames. So if we look at the chart here, I'm very glad that I did, because on lower time frames you see a lot more choppiness. Well, let's look at the even more extreme. When we go to the 15-minute, yeah, you see really choppy areas like this, like this, like this. You know, and so on and so on, right? A choppy area there. I mean, there's just endless examples of this kind of market choppiness, right? Where it's very difficult to say, okay, that's the high point, that's the low, but it's much harder to read. When you go onto the daily, for example, to look at another two extremes, it's much easier to identify. So it's much easier to identify, you know, up there's the high point. There we go, there's a low point there, high point there. It's much easier to identify these kind of moves on the daily. So what I'm getting at is I learned on the hourly, and as a result, when I went up to higher time frames, I found it incredibly easy. Because the other way around, it might have been that I got to read the higher time frames and then struggled with the lower time frames and had to relearn what to do. So there's a considerable benefit of learning on lower time frames. A lot of traders, especially learning, are attracted to lower time frames because that seems to be where the activity happens. You'll find on lower time frames, your setups, your trades, the execution, the play out of the actual trade happens much more quickly, relatively speaking. On a really high time frame, you know, 4 hourly or even the daily, it could take ages for a setup. Now, that sounds like, oh, well, all the activities down below, that's what we want. No, that's not always the best thing, because some traders find that they start off on lower time frames, but they eventually suffer from burnout. Now, that might be a bit strong. It might not be that they actually burn out, although some will do. They get tired of the constant attention required to trade lower time frames and would rather trade higher time frames where they can just see a setup, develop over sometimes several days and then play out gradually. And it requires less immediate attention. And if you want to sit at charts and that's what you want to do, fair enough. But some traders find they want to do things in between setups. So they want more time in between setups. Considerable benefits of the higher time frames are it takes longer, it requires less direct attention, which sometimes means you are then freer to trade more strategies, more pairs, if you want to expand your portfolio that way, using the time it's freed up. Now, the higher time frames, you'll probably be trading bigger moves. Therefore, your profits will be bigger, relatively speaking, because you'll have captured a bigger move. You would think the downside to that would also be larger distances between entry and stop loss, larger losses. And that is true. But when you have a larger distance, a larger stop loss, a larger distance between entry and stop loss, one of the advantages of that is it's less likely that all that short-term market choppiness will push you past your stop loss, will stop you out. So in a way, it takes a bigger move to prove you wrong. There's also an advantage in that it's easier to see bigger overall trends and bigger important structural points on higher time frames. So you sometimes find that some traders will have the best of both worlds. They'll trade the lower time frames, but they'll check constantly on higher time frames to look out for those key structure points they want to avoid or take notice of. It's easier to notice the significant structure and resistance points on higher time frames. However, one of the downsides of higher time frames is it takes longer for your trade to play out. And yes, that might mean less volatility, less likely to get stopped out by a short-term move, etc. But it also means you have to watch that trade play out, and it takes longer for you to know if you are going to be in a winning trade or a losing trade. And some traders really struggle with that. Some traders design their trading around the fact that they don't want to wait a long time to know if the trade is going to play out in their favor or not. So that, again, is something to bear in mind, your own personal psychology. The other thing to bear in mind is if you're going through a drawdown, a run of losing trades, If you have fewer trades over a period of time because you're on a higher time frame, your drawdowns last longer. If you're in a drawdown on a lower time frame, it's a much shorter time period you have to wait before that run of losing trades is broken by a winner. So there are pluses and minuses to either one of them, and you need to build your trading plan of which time frames you're going to trade based on your own personal desires, your own personal trading psychology, and what you want out of trading.